Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 21. When should we execute our option selling trades? And we're going to use one of the Greeks, Theta, to assist in our timing decisions. You know, one of the decisions that option sellers have to make consists of when should we enter our trades, when should we execute any position management trades, and when should we roll our options if we're going to decide to do that at the end of the contract month. So in this podcast, we're going to make those decisions based on Theta and based on what's best in terms of generating the highest possible returns. So as it relates to trade timing decisions, basically there are three categories we're going to look at. First of all, when do we enter our initial trades? For covered call writing, that's buying a stock and selling the option. If we already own the stock, then when should we sell the option as it relates to that particular contract month? And many of you know that a contract month is not the same thing as a calendar month. It begins after the third Friday of the previous month and extends on to the contracts of the third Friday of the next month. So when do we enter our initial trades? And then when do we execute our mid-contract exit strategies? If those opportunities come up, when should we execute them? And then finally, when do we roll our options if the strike is in the money as expiration is approaching and if we want to retain our shares? So those are the three categories of decisions that we have to make as covered call writers or as put sellers. Now, if we were to take a look at theta or time value erosion, the way our premiums erode related to the time value component of those premiums during a monthly contract. Now, if we were to sell a deep in the money or an in the money option, that time value erosion is linear in nature. It's like a straight line. However, as covered call writers and put sellers, we are basically selling near the money strikes in order to generate the kind of premiums that we look to get as we sell our options. In that case, the theta chart is logarithmic in nature. What that means is it starts off very slowly on the left hand of a graph, and then as expiration is approaching, it literally falls off a cliff. So that tells us that at the beginning of the contract, the time value that we would generate when we sell our option is eroding at a very slow pace. But as the mid-contract and later in the contract progresses, the time value is very, very low, or it starts to erode away very, very quickly. So what does that mean? Well, that means that we want to enter our covered call trades on the Monday or Tuesday after expiration Friday. Why? Because we don't want theta to start eroding away our potential time value premium. We're only taking a 1 month obligation. Some of us only take on weekly obligations, but most BCI investors use monthly contracts. That's my sweet spot. So we want to sell it on the Monday or Tuesday after expiration Friday or after the third Friday of the month so that we don't lose too much as a result of theta deterioration. Now, I also like to place my initial trades between 11 a.m. and 3 p.m. Eastern time because the beginning of a trading day and the end of a trading day has quite a bit of computerized institutional trading, which creates a lot of market volatility. So I like to enter my trades when there is low volatility, and therefore I can buy my stock and sell my options without worrying about too much discrepancy between the time that I educated myself and screened for the stock and the option and the time that I actually executed the trade. So between 11 a.m. and 3 p.m. Eastern time is when I like to enter my new trades. Now, once we enter the new trades, in other words, we bought the stock, we sold the option, now what? We immediately enter a buy to close limit order using the 20%, 10% guidelines. So what that means is if we bought a stock for 48 and sold the 50 call for $2, we immediately place a buy to close limit order to buy back that option at 40 cents or less, 20% of the $2. So we go into our trading platform, buy to close limit order under options, and put a limit order at 40 cents. Midway through the contract, we change that to 10% of the original $2 or 20 cents. The reason for that is, once again, if you looked at a chart of Theta, you'll realize that for near the money strikes, the time value erosion in the latter part of the contract literally falls off a cliff. And there's less opportunity to make money, and that's why I'm willing to spend only 10% to buy back that option. But initially, we put in using the 20% guideline. So bought the stock, sold the option, and then entered the buy to close limit order based on 20%. Now, what about exit strategies, position management? Well, once we enter the buy to close limit order, if the price of the stock declines to the point where the value of the premium is at 20% or 10%, then that trade will be executed immediately, right? Anytime that threshold is met. We don't even have to be in front of our computer. So we take advantage of that by automating it using these buy to close limit orders. However, there are other exit strategies that we could use, like the mid-contract unwind exit strategy, or just closing the entire position. And when those opportunities arise, we can take advantage of those at any time and at any hour during the trading day. So whenever the exit strategy opportunities arise, we take advantage of them. Now, as I said, the buy to close limit orders will happen automatically. So when we enter those trades, we enter them and not at day only, but at good to cancel. So they'll stay in our brokerage platform during the entire contract month. Okay, so buy to close at 20% or 10%, good till cancel. What about rolling our options? Well, rolling our option applies when the strike price is in the money or lower than current market value of the stock as expiration is approaching 4 p.m. Eastern Time on the third Friday of the month. Now, whether we're going to roll the option, well, that's contingent on several factors. Number one, does the stock still meet our system criteria? Is it still fundamentally and technically sound? The answer is probably yes if the strike is in the money. It's not like the stock declined in value significantly. Make sure there are no upcoming earnings reports. That's the BCI golden rule of avoiding earnings reports. So that's the most significant reason why we may not want to roll the option. And of course, make sure that the calculations, buying to close and selling to open, meets our initial time value return goal range. In my case, it's 2 to 4% a month. In my mom's account where I use ETFs, it's 1 to 2% a month. And that'll vary from investor to investor, depending on your goal and your personal risk tolerance. So we want to roll as close to expiration as possible, because going back to that Theta chart, it will literally fall off a cliff. So the time value component of buying back the option will be at its lowest as we approach 4 p.m. Eastern Time on the third Friday of the month. And the next month's option will not deteriorate as quickly because of that same chart, the logarithmic nature of Theta, or time value erosion. So it will be to our benefit to come as close to 4 p.m. Eastern Time as possible. But let's not get crazy about it. If you're not going to be in front of your computer in the afternoon, that Friday afternoon, you could do it in the morning or the day before. But it will be slightly to our advantage to wait as close as possible. I normally start rolling my options about 1 or 2 o'clock in the afternoon on expiration Friday. Now here's kind of a bonus chart for those of you watching it, or for those of you listening to the podcast. I'm just going to go through a few things. If you had a stock-only portfolio, now this doesn't apply to options. So if you have a stock only, I just thought I would give you some information on the best times to purchase and sell. So you want to avoid early morning and late afternoon hours. We already said that applies to both options and just stock-only portfolios. Good days to buy on Mondays. Why? Because of the Monday effect, which factors in the negative news from the weekend. So you might get a good bargain on a Monday. Best time to sell? Well, Fridays, especially prior to a 3-day weekend. So again, Mondays, the prices tend to go down. Fridays, you're at a peak, so that's a good time to sell. The best months to buy a stock historically, December, January, and in the summer. These are just historical data. And the worst month to buy historically is September. What about the days of the month? Well, historically, mid-month seems to be the best or the sweet spot, say between the 10th and the 15th of a calendar month. This again applies to stock only. I really would take this with a grain of salt because, there may be factors affecting the price of individual securities, making other times better. But I just thought I'd give you a little historical perspective on buying and selling stocks. Let's summarize. Entering a trade the Monday or Tuesday after expiration Friday. And this relates to the graph of Theta, the logarithmic nature of the time value erosion of our option premiums. Exit strategies, we got to jump on those whenever those opportunities arise. And you can automate the buy to close with limit orders using the 20%, 10% guidelines. As far as rolling options is concerned, expiration Friday mid-afternoon is the best time to begin rolling your options. However, if you're not going to be available in front of your computer on Friday afternoon, fine, do Thursday. Do the best you can. Now, the reason exit strategies is so important is it allows us to mitigate losses. It allows us to enhance gains, and it will definitely elevate our final returns if we have mastered the third required skill of position management. Okay, so for those of you who are covered call writers, I know most of you already have copies of the basic Ellman calculator, but if you do not, you can go to our website, thebluecollarinvestor.com. At the top black bar of our web pages, click on the free resources link, and you can download the basic Ellman calculator and its user guide to your device. There's also a put calculator and several other files that you'll find very useful for selling options. We also have books, DVD programs, calculators, and other tools. The Complete Encyclopedia for Covered Call Writing Classic Edition has been #1 on covered call writing for years. That book should be read first before Volume 2. And we also have a recently updated covered call writing online streaming DVD program with a downloadable workbook. Definitely something that will enhance your skill level as it relates to covered call writing. So, ladies and gentlemen, that ends BCI podcast number 21. When should we execute our option selling trades? I want to thank everybody for listening in and watching this podcast. I hope you enjoyed it, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.